Good morning, everybody. Welcome to the Flow Show. Yeah, it's Friday, and let me shut that up. And yeah, the last day of the week, first day of the month, and a big month it's going to be. Well, for at least 2 weeks anyway. Morning, Kay. How you doing, mate?
PGIF, and welcome to December. Good morning, Ryan. So we ended November with snow, and we start December with a very nice sunshine where I am, but it's freezing cold, right?
Yeah, very icy out and about around here. So to sit in the car for about 10 minutes and let it thaw out. I can't be bothered to scrape windows. I just sit there and let the car do its thing. So yeah, very
Hey,
taters this morning.
nice scrap, by the way, by West Ham yesterday as well. Well, while you're talking about scraping.
Yeah, that was hard work. That felt like that game felt like the whole of this week. Bit slow and dragging, but yeah, we managed to get the win last night. Not the greatest of games, but 3 points is 3 points, as they say.
Exactly.
So yeah, not going to complain about that. Not much complaining today with trading either. So let's get stuck into some of the headlines. PBOC, they just ticked up their fix back to 711 from 710s. Not going to read anything too much into that right now, but it's the first time they've taken it up a step for probably quite some time. So just going to keep an eye on that to see whether they have decided that enough is enough for the drop in dollar China. Data out from those guys as well. Some more PMI data, this time from the private survey, the Kaijin survey. That one went the other way to what we saw in the other number. Expansion for manufacturing on this one. 50.7 versus 49.3 expected. So I was expected to lose a couple of pips, and it gained quite significantly into expansion. So bit of a mixed picture coming out from over there. Japan as well saw a little bit of an improvement on their flash number, over their expected number, 48.3, but still down on last month's 48.7. I might as well knock out all the rest of the PMIs and whatnot as we've got it on the screen. Spain there, this is first and final number, a little bit of an improvement, 46.3. As you can see there, a bit of a similar picture coming in, even Swiss up a little bit. Italy let the side down, theirs went backwards, was expected to rise to 45.3, went lower to 44.4, all the fours. Again, this was the first and final number. Then we got the final numbers from France, Germany, Italy, and all the rest. France, again, a little bit better, actually up on last month, beating the flash number, 42.6, and what was expected. Germany, the same, pull back into, well, less crappy, not as crappy as the 40.8 they had the month before. Italy, their final GDP number turned it around, was expected to come in flat, and they saw a 0.1% gain. Whoopee, jelly and ice cream over there. Even the good old Greeks had an improvement on their manufacturing, 50.9. And you can see the rest of them there. The pan-Eurozone number also improving, 44.2 versus 43.8 flash and 43.1 prior. So a little bit of an improvement there. Lastly, UK down the bottom there, same thing, a little bit of improvement. All still quite deep into contraction though. So just at the moment, things haven't got worse. Not yet getting markedly better. My main take from all these PMIs was pretty much in all of them an acceleration in lower prices, be it input prices or output prices. The only one that was different was the UK, which saw lower input prices but higher output prices. So firms continuing to increase prices of goods they are selling. So that keeps the sticky factor in inflation potentially for the UK, although the manufacturing sector isn't a huge sector in terms of its effect on the economy, but manufacturing probably has bigger price costs to it. Goods are far more expensive when you're buying raw materials, that sort of thing. So anyway, sticky in the UK, softer pricing across the Eurozone PMIs. Let's hop back to Japan. Finance Minister Suzuki had something else to talk about other than FX levels. He says that firms need to use cash on wages and investment. And there's also headlines out from one of the large, or perhaps the largest trade union, Rengo, says that it's formally agreed on what they're going to demand as pay hikes in 2024, and that demand is 5% or more. Now, this headline dropped up, probably my early state. I read it like they'd agreed the 5% wage hike, but it's not. They've agreed to demand 5% in the spring negotiations. This was touted back in October, but Japan being Japan, they can never do anything quickly, so it's taken that long for them to actually agree that they're going to demand 5% or more. But at least that gives us a bit of a lead into these spring negotiations from some of the big firms over there. And another little, let's say, Japan starting to come around to the idea of higher rates because the Kyushu Electric Power Company sold 15 billion yen of debt, and they did it over TIBOR, which is the Tokyo Interbank offered rate. Basically, it means that the interest is a floating interest rate rather than a fixed interest rate. It's a floating interest rate. So if rates go up, that's reflected in the TIBOR, then these bonds will pay out over TIBOR. I don't know what the number is over TIBOR, but it just means that investors who buy these bonds, if rates start creeping up, they get the benefit of that. Not something that's been done a lot in Japan. I don't know if you know when the last time this they did a floating rate bond over there, Kay, but it's just another sign that Japan's coming around to rates might be going up.
Yeah, it's well, first of all, to your question, I don't recall having seen one since I traded yen, but yeah, and it was also not that it couldn't have been popular because I mean everything was frozen over there for 25 years, so in the rate sphere. Yeah, it's a way of trying to attract investors, right? With the promise that they will pay higher rates if needed. We also have to know that those energy companies, and I think they may be not too far from bringing a few back online. Those nuclear plants, it took an awful lot of time after the big quake, and then with the pandemic, things have been pushed back as well. But we may see some of those nuclear plants come online relatively soon as well, and they obviously need cash now to because it's a very lengthy and costly process to do so, and yeah, attaching it to TIBOR is a way of telling the investors that they will pay market prices and not like 0.5% or 70 BPs or so. If creeps up to 1.5, they will pay that, which is still very reasonable. But compared to what they used to pay on bonds, it's of course a big somewhere a big change. We'll have to see if the other, especially the energy companies, will follow suit, like the TEPCOs and things. Which are the TEPCO is the bigger one, right? KEP is the Kyushu Electricity company, which is still a major one, but not as big as TEPCO. And TEPCO was the one which really got affected by the big quake in the northeast of Japan. So just that for a little bit of history and background on those electricity companies. Yeah. While you're on Japan, shall I mention it, or those articles of the pension funds, and or were you going to talk about it and CPI?
No, you can go ahead.
Yeah, there's two articles, and thanks, Gav, as usual, for updating our news and research room early in the morning. That's very much appreciated, mate. There's two articles this morning. So one is a poll, is a Reuters poll, saying that Tokyo core CPI could be slowing down to 2.5% in November. That number comes out next week, which we take as Ueda may be right after all, because he said second half of the year, which I always understood their fiscal year, which we are in now. Inflation would come down to perhaps later accelerate again. So this poll is saying that it could come off to 2.5%, even 2.4%. So that brings us closer to that brings us closer to Japan's target, let's say, everybody's target. So that means Ueda may be tempted to even go slower if inflation comes down. And then there was the other article about the Japanese pension funds saying that they have gone more unhedged on their foreign bond holdings. And that means that they actually expect the yen not to strengthen too much, because otherwise they would not unhedge more. If they would expect the yen to strengthen, they would go completely hedged on, or over, at least over the 50% mark, hedged on their foreign bonds. They have started to unhedged, which may actually have been part of the reasons why the dollar yen hasn't really come off that much compared to other dollar pairs in November, and why also the yen crosses have been rather big. But so that process, which had been announced somewhere end of the summer, they have put this in motion. So, but that means two things. So, and it's a real double-edged sword. Okay, so of course Japanese pension funds, they know what's going on in house in the Japanese economy and stuff better than others. But and that could mean that they say like, okay, because they actually do it on the back of expectations that the Bank of Japan is going to be so slow. But then if you read through those articles, and that could be a bit counterintuitive, but it could actually mean relatively good for the yen, in a way that if CPI comes down, we see CPI coming down elsewhere as well. But we know that the Bank of Japan is putting a lot of weight on those higher wages. Imagine that those higher wages during the spring negotiations come to fruition, and we get 4.5%, 5% hike in wages, where CPI comes down to 2.5%. Those hikes in wages should mean that the real wages in Japan are actually getting finally positive, which in turn may tell the Bank of Japan that they can start to normalize, where in the rest of the world CPI is also coming down, and where we start to expect rate cuts in 2024 from all their major counterparts. Couple that to the Japanese pension fund going more unhedged, meaning that they are now more exposed to a stronger yen. I think, and again, as I said in the room, there's still a lot of water to flow through Tokyo Bay before all those things materialize. But it could indeed mean actually relatively good for the yen down the road. I repeat, down the road. We are probably not there yet. We don't know exactly what those wage negotiations are going to bring. But it could actually, somewhere down the road in 2024, all of a sudden start to be looking much better for the yen if the Bank of Japan normalizes on the back of higher wages.
Yeah, and that I mean, we spoke about that earlier this week, didn't we? It would be quite a thing if inflation fell down, even while wages are going up, and it put them in a bit of a pickle. How to explain that one away on the CPI front? But you have to imagine that higher wages would naturally bring inflation with it, because it encourages people to spend more, and then it encourages firms more comfortable putting prices up, that sort of thing. So it's all getting it's turning the oil tanker with a teaspoon. This is one of the analogies I've used previously with Japan. You know, it's a very slow thing, and we are seeing the turns. You know, this bond sale with floating rates. You know, again, that's another little sign of mentality changing, and it's a big shift that's got to be undertaken over there. But in terms of the wages and inflation, you know, again, in my head, I'm seeing an opportunity if inflation starts coming down, and we get actually both Tokyo and the headline CPI numbers. I think on Monday, this Monday coming, so that'll be the last inflation data before the Bank of Japan.
Monday or Tuesday? I think it's the 5th.
What is the 4th? Is it Tuesday, the 4th?
I think 5th. No, is it on the 5th?
No, it's on
the.
Yeah, it's on the 4th. I looked at it. I'll check.
Late evening for us.
Oh yeah, so it'll be morning of the 5th then. Yeah.
Yeah. Okay. So we're both right.
Yeah. Yeah, I like that. I like that. Let's have a look just to double check.
You're correct. It's Monday night for us.
Monday night for us. Yeah, Tuesday morning for them. So, and yeah, it's going to be both. Where am I? I think it's going to be both. Let me double check that as well now. You've got me talking about it. Yeah, so it looks like we got the Tokyo numbers and the headline numbers. Usually you get the Tokyo before a week or so before the main numbers. So potentially, yeah, if that's right. Yeah.
It's strange because it says that they only expect the Tokyo CPI expectation. There is no expectation for the global one.
Well, I saw that one there, which wasn't a Tokyo one.
All right, but let's assume it is coming down to Ueda. I think the first reaction may be actually that people will try to sell yen because thinking that Ueda is right, Tokyo CPI goes down. But then thinking about it further down the road and those articles about those pension funds as well and those wages, I think I mean, but it's again, I mean, that then comes back the carry and the funding into play as well. You can't be long yen too early, right? Unless you're right relatively quickly.
Yeah, exactly. But as I say, I think there's an opportunity there because the market will react to the CPI numbers, and we all know at the back of our minds we're going to get pretty strong wage negotiations that will potentially have the BOJ tightening, even if inflation is hovering around target, even if it is edging a bit lower. So, you know, that could be maybe a last hurrah up for yen pairs to jump on. But as we all know, timing is going to be key. You know, you probably don't want to be doing anything into the end of the year, you know, after the BOJ, because then you're just sitting there with 2 weeks of carry costs while it does nothing.
Yeah, that's a fair point as well. I mean, it's probably the big long yen position, if it is warranted. The big long yen position may be something for February or so.
Yeah. I'm going to have FOMO well before that, mate. I'm already itching.
Yeah, talking about it, your mouse is already hovering above the cell phone right now.
It is, mate. I've been itching all week to say. Every time I see a decent rally, I think, go on, just put a little bit on, and then I hesitate, and it drops again, and I go, oh right, leave it alone. So yeah, I've got the real big itch to be short this one, but I'm going to try and sit on my hands for a bit, and yeah, or maybe get into one of the other ones that isn't so carry heavy. I don't know which one that is, but yeah, we'll have a look.
Euro yen, perhaps.
Anyway, what?
Euro yen, perhaps.
Yeah, euro yen, or even Swiss yen. I don't know. Then you got to deal with clouds over in Switzerland. Yeah, right. Stick to what you know, Ryan. Stick to what you know. Right, well, let's crack on before we end up talking about Japan all morning. Riksbank's Thaden says that the fact the Riksbank decided to hold rates unchanged should not be interpreted as meaning that inflation risks have disappeared and that rates will fall rapidly. So playing a higher for longer game over there. BOE's Green was a little bit hawkish yesterday. Said policy is less restrictive than previously expected. So that's going to, we know there's going to be at least one hawkish slant to the next Bank of England meeting. ECB's Nagel, our old mate, is up again. Risks to inflation are skewed to the upside and further rate hikes can't be ruled out. I had I checked, okay, a bit I decided to have a look. He's spoken probably 12, 13 times in the last 2 months. That's how many times he's spoken, and probably 6 or 7 of those were in November alone. I don't know, I might see if it's easy enough to keep score on who speaks the most. We'll have a little bit of an awards ceremony at the end of 2024, which central banker spoke the most, but a lot of waffling from this guy. On the ECB, Goldies have shifted their chess pieces again. They now expect the ECB to cut in Q2 2024 from Q3 2024. Bank of America still expects the ECB to wait until June to cut, but an earlier move is no longer unthinkable. So all the shifting sands going on with rate cut guesses going on now. We had initial jobless claims yesterday, as well as some other data out of the US. Jobless claims was okay. They were about 218, but we did see a big jump up in continued claims. So that's we had a little pullback. We've been seeing a trend higher. We had a little pullback, but now that's quite a significant jump in continued claims. Still running below sort of real long-term averages, you know, if you take out all the COVID moves and whatnot. So I think if we start trending above 2 million, the market's going to get a little bit antsy over the jobs numbers. Obviously, NFP is next week, not this week. So we won't get a full look at those jobs numbers until then. PCE data out yesterday as well was they're about all pretty much on the money in terms of expectations. So no real move on that, confirming things going the right way. Income and spending as expected, up, but a little bit less than last month, but no big negative flags, negative numbers coming in for those. In Canada, average weekly earnings up a pip to 4% from 3.9%. GDP over there, I mean, this was bonkers yesterday. It came in at, or the annualized year-on-year number came in at 0.5%. Okay, the prior was minus 0.2%. Sorry, this one wasn't it? The annualized, yeah. The prior was minus 0.2%. It got revised to up 1.4%. But the annualized number coming in down 1.1%. So, Kate, I'll let you explain the Canada GDP numbers. Is it good or is it bad, or do we even give a monkeys?
It was bad. Well, I mean, the hairy hindsight says it was bad for 2 minutes, then went really good for a couple of hours, and now we don't know. So that's the pure economical explanation.
Exactly. I mean, these guys forecasting
blind darts, mate. Blind darts.
Yeah. These guys have got history. Stats can, and for those that remember the old Canada ADP that used to come in minus 300 one month and then we get revised to plus 500 the next month. So yeah, all over the shop. Right, let's move on with enough of that. After that, we got just some pending home sales, which came in not as soft as expected, but still a negative number. Was a positive number the prior month. So another indicating housing that's not looking too hot, but it's been a very mixed picture thus far for the October data. And over to the Fed heads. Fed's Daily says it's still too early to know if the Fed is done raising rates. Should take our time now and remain vigilant and act prudently. We need to better understand what is happening with the economy and inflation, then need to be prepared to either raise rates again if necessary, or say the tightening cycle is complete if that is appropriate. Feds Williams repeated his stance that the Fed is at or near peak interest rates. Then he got asked a question but declined to speculate on the conditions leading to rate cuts, and then a bit afterwards said rate cuts depend on developments in the economy and inflation. No shit, Sherlock. The thing to look for with all these central bankers, and particularly the Fed central bankers, is not so much if they're repeating comments, if they're changing their stances. We saw Mesta slightly change her stance from hawkish to less hawkish to more neutral. You still have the ones who are sticking to their guns like Bowman and Daly, still not ready to give up on what's happening with rates and further hikes. So it's all about those that change their minds. Not that it matters, because after Powell today, later on today, 2 appearances, they go into blackout. So once he's said something, if he says something, then we're done. Short-term interest rate futures for the Fed see them holding steady through March and then starting cuts in May. So quickly on Powell, Kay. Every time I read or hear a comment in the market, flashing through the wires or FinTwit or whatever, it's, oh, Powell should say this or Powell could say that. He might not say anything at all, really, but the market seems to think he is going to say something.
Yeah.
What does he do if he doesn't mention anything?
Yeah, that's actually pretty good question, and it may be the main question actually, because we know that Powell walks the fine line. I think the market is expecting him to go more onto the dovish side, but I'm not even sure that the venue where he is today is really a platform to go and announce things. It's not like a Davos or the Jackson Hole, or it's much less important. Now, the importance for the market is it comes right before the blackout. So if you really want to go and pick things out, there is perhaps a question that we could ask ourselves, is he going to fight back against what Waller said? Because Waller went completely in a few months' time from being one of the Uber hawks to now being a big dove, right? And is he going to fight back against him, especially? And that's perhaps the most the biggest detail also that he may say. But we know that Powell is usually walking a very fine line, covering all bases. We've seen it so many times in this year's press conferences or chats that he had. He starts one way and then he slowly slides into the other way. Whether he starts with the dovish things and then goes on to the more hawkish things. Okay.
Do you think?
It's always.
Do you think there's anything in them? Do you think, as we sit here now, there's anything the market's done that would bring him out to say something like, if we'd seen 2-year yields down at 4.25% or 4% and 10-year yields at 4%, you could probably say, well, actually going into Powell, there's been an overreaction in the market and he needs to correct that. Do you see that we've got anything like that going on that he would need to come out and correct?
I personally don't think that he is going to, but it could be. We're coming out of the biggest month for many years in the equity markets rallies, and we're coming out of the biggest month in the bond rally. Some bonds since the global financial crisis, and I've seen global bonds supposedly put in the best performance since the 1980s. If you look at the global bonds. So there is this possibility. Will he do it? I personally doubt it, but he could. He just could, because financial conditions are not really tightening anymore, even though the QT zooms in the background. And I've seen some people starting to talk that the RRP facilities, the reserves are coming down. So which, if they come down too much, it could spark rate cuts. But they've already said that QT would continue to run for longer even than when they start to move rates again. So personally, I don't think he's going to say anything earth-shocking. The issue is that we are coming out of the month of November right on that big level in the tens. Around that 430 zone. As we are on a big level in the twos. We are on a big level in the fives as well. So the thing is, again, every word that he says will be dissected, and enough for even would it be algos to try and take it one side or the other because they heard something or they translated something into a trading trigger, right? So that is the thing. That is the risk, that we are seeing a very volatile market at the end of this week, and actually, if you can take it, it's still perhaps like end of November into December, you know, and that is the risk that we have this afternoon, that we have increased volatility for not too much reason.
Yeah, I think so. I think for today, there's two things that can happen. Okay, he does say something on monetary policy and the economy, and then we just have to roll with the punches, whether he talks hawkishly or dovishly, or he doesn't say anything at all. And I think if he doesn't say anything at all, the market is going to push on the dovish side, because that's the way we're leaning, and the market will go, well, he hasn't said anything hawkish, therefore we're going to take that as we can carry on doing what we've been doing and pricing cuts and move into the dovish side. So that's your risk. Yeah, that's your risk for today. So if he does talk on monetary policy, then you have to go with whatever he says. If he doesn't, then expect probably yields to come under pressure, the dollar to come under a bit of pressure going into the latter part. But one of his the second part of his thing, I think, is about 7 o'clock tonight. So there's not going to be many people around in Europe to
Won't be
trade that one. It's going to be a right low liquidity time of day. So,
but do we perhaps there's a speech coming out around the first stuff. There could be some introductory speech also where the main lines are already in there. Let's hope it, because I won't be around for the last one. Yeah, but you're right. I mean, saying nothing is likely going to be taken as dovish, and also that's where the importance of the blackout period comes out. Because what did you say, CPI 12th or so?
Yeah, CPI the 12th.
Hey, that gives nearly 2 weeks of uncertainty, right?
Yeah. So
if he says, or if he doesn't say anything, it could be important for the next 12 days or 11 days. Let's put it that way.
Yeah, and that's something I just wanted to highlight today as well. Here's all the major central banks coming up in December. So next week we get RBA, BOC, and then week commencing the 11th, we get all the rest of them, bar the Bank of Japan, who annoyingly had to do theirs on the 19th. They couldn't let us close up for Christmas. They wanted to do it that week running into Christmas. But anyway, and of those, 4 of them have CPI reports out. Japan, Switzerland next week, Norway the 11th, the US before the 12th. And I think that one is going to be a biggie, because that CPI number is going to massively have people running around with expectations for the FOMC. If it's a high print, then the market's going to turn all hawkish and think we're going to get something hawkish. If it's a low print, maybe we see a 2 handle on the headline CPI, it's going to get all dovish for the FOMC. So it's going to be a very tricky week, that one in particular. Right, last thing to talk about, OPEC. For those of you who follow oil, they had all their usual shenanigans going on, rumours, going to do this, going to do that, coming out. In the end, it's settled around about a 2 million barrel per day cut, but that's pretty much a million, well, 2.2 million, however you want to count it. That comes with the Saudis pretty much doing what they were and the rest adding to it. Then we've already had people like Algeria agreeing to cuts and then saying, no, we'll shove your cuts up your ass. We're going to do our own thing. So it's the usual bum fight that's happened in oil. It went pretty much as I thought it might. We get a rally on the headlines if it was towards a strong end, and then we crap out after. And I wasn't expecting it to crap out that quickly. I thought it might just drift a bit lower. But there you can see there's all the expectation yesterday into the meeting, all the announcements, and then off it goes. And I know a lot of the guys and girls in our room did very well trading that one on the short side. So well done to them. Right, just looking around some of the other pairs quickly. Roberto, did we cover indices? No, haven't covered indices yet, so we can have a quick look at those. Have a quick look at the S&P and some of the others. S&P, what's it doing? Not an awful lot, really. I thought we might see a bit more of a sell-off in this one this week with those rebalancing stuff being done. Maybe that's what that move was into the latter part of yesterday, end of month. But as you can see, we're back. It's keeping its bullish bias for now. So maybe we are then going to get a knock up to the 46 level. Again, this might be one, at least for futures, later on is going to be decided by what Powell says. So maybe we get a bit of treading water because that's the big risk event today. Gold as well. That's seen a little bit. I can't find it. I've got too much stuff in my lists here. Where's it gone? Come on, gold. Where are you?
I mean, you don't have the one that Roberto is asking about.
What's he asking about? Have I missed it?
No,
down. Oh, down. Well, you want to look at the, right. All right, we'll have a look at the down in a minute. So we're still sitting up here, up against these high points, and you know about this. There's some big, longer-term highs in play up around these levels. So we're just holding below this prior one around the 60s that we got earlier this year. Just coming into the shorter term. You know, we're just finding a bit of traffic up here at the moment, finding it a bit tough to get through, almost a bit similar to, you know, what we had here, where you find a top, then you get a pullback, find a top. I'm not suggesting we're going to see exactly the same price action, but for those who want to pick tops, this is the price action you want to be looking for. You want evidence that we're not getting through a level, then it gives you some conviction to maybe try shorts, but be careful how many times we've tested. This is, you know, give or take 3 times we've come up here. The more times we come to a level, the greater the chance is that we break it. So if you are playing shorts off this level, you might want to be thinking about where your stop goes and potentially flipping it. Because if it breaks like we had down here, test, then boom, off it goes, and then you're off and running. So, you know, whatever your view on gold is or any asset, you know, the price action can tell you how to trade it, irrespective. You think gold should be at 1900, well, it's not. But there's nothing wrong in buying a break if that's what the price action is telling you. So don't marry your bias. And what you think you know is not what the market probably knows, and it's got bigger pockets. Right, coming into just a quick look at some of the majors, and I'll hand it over to the K-Man. Euro dollar broke down below 109.10, which I've been mentioning all week, in an on-off area. It's now holding below there. We're now moving below the big figure as well. We had a low yesterday down in low 80s, 79s. We're on our way back to that at the moment. So it looks like we might be heading a bit lower. Then we've got my zone coming into play here. We'll see what happens with that. We had a move up and down, pretty much held, got the springboard. We'll see if that happens again. If we do get below 108.30, then, you know, 108 is going to be a big line in the sand. Under there, we're going to start undoing a lot of this trend, and it will look far more bearish for the euro. It's not looking too hot at the moment, but, you know, it's not starting to break the trend yet until we get through that 38.2 fib, and we're still a bit of a way from that at the moment. Euro sterling, another one looking a bit soggy. It's carving through the levels. We've got some fairly decent support down here. Again, tens is a big figure just around this area that we've seen. Then we got the big figure. Then we got the 61.8 fib, which again is pretty much on the big figure, 85.97. Past that, we're probably going to be down to 85.17, maybe even looking at the mid 85s probably after that. So again, not looking too hot on this one, but as we know, it can change in an instant. Cable, the pound is still looking like a favoured currency at the moment. I would look to reload my longs if we had another move down to 85, depending on what this looked like. If it carried on going in a straight line, I'd probably hit it. If it started grinding and we started seeing better data from the UK than Eurozone, I might hold off and just see what it does. I know you still short this 1K?
No, mate. I mean, it was my end of month play, and I covered it on the fixing, as I said. because I didn't know what is going to happen really in December. We've seen this morning. Okay, euro sterling is going down, but all the euro crosses are going down. So what happens? We had this move into end of month, which I expected. On the Swiss was one of my currencies as well that I was monitoring, but we saw it on all the crosses. And today we are seeing some continuation, whether it is leftovers, but I do think it's a bit of follow through on the back of those weaker European CPIs that we see all those euro crosses under pressure. So yeah, that one, the Euro CAD was one that some banks, well, a bank at least was hinting at that there were going to be big Canadian dollar purchases as well. That's been done. We have followed through this morning. The dollar CAD though, and we are having the Canadian labor report. The dollar CAD is coming to rest on pretty important, on a relatively important level there around 135. It's really the question of the day on the Canadian labor report is whether we hold 135 or not on the dollar Canada. If we don't, then, and we have the same chart relatively, so don't have to show mine. If we break through 135, I think the possibility is there for a quick run down to 134. If we really have a good labor report, right? And let's just repeat what we're looking at. We're looking at a headline. We're looking at the unemployment rate, but for those new to markets or new to our show, we have to repeat that for the viability of any move, it is important to look also on the balance between part-time and full-time employment, right? So that you have a move on the initial numbers, but then look at that balance. If the balance goes more into full-time, that usually gives you a more viable move after the initial wave. Okay, so but assuming that the report is good, I think the 134 test may be on the cards. If it's bad, then I reckon people will, rightfully or not, but will remember that stupid GDP yesterday and perhaps take dollar CAD back up to somewhere closer to 136. Yeah, that's basically it for this afternoon. Could be pretty binary, and then we wait for Powell to add some to the move that we have already seen in the CAD, or reverse the dollar CAD. Really,
you put a lot of faith in stats can again, mate.
Yeah, I know, but I mean, whether they're right or wrong, data, it's always funny because I mean, there's so many model funds trading now that they just put those numbers in their model, and that's what they trade, really, right?
Yeah, we do have ISM today, manufacturing ISM. So we do have some data from the US and some big ticket data from the US. That at least replaces the NFP that we usually get at the beginning of the month. As I say, that's next week. So some last minute things for the US as well ahead of Powell. Right, Kate, I'm going to hand it over. I'm sure you're going to look at the Dow for.
Yeah, I've put it up, and I've quickly drawn 2 lines on there. So perhaps you can.
I thought I heard you scribbling away.
Just help.
I thought I heard you scribbling away, getting some lines on the chart.
Sorry. Okay, Roberto. This is the very, very simple look. Okay, it's in an upward channel, but we are coming into what I think is going to be an important resistance here, just above 36,000. Okay, call it 36,200. We are breaking successively above prior highs, so that means that there's still confidence. There's still a lot of talk going on, and we heard it throughout November that that funds were underinvested because everybody was looking for a weaker equity markets, or at least not believing in these up moves in the equity markets globally, and Dow has not been an exception. If you look at across the equity markets across the globe, really, barring China also. You look at the European indices; they also have been gone to the races during the month of November. So, but keep an eye on what's going to happen around here, 36,200. That's probably the gateway to those levels, 36.6 and then close to 37,000. Okay. On the way back down, okay, you have this prior high, which may already be good enough for a bit of a support, or a bit of a people thinking that that it may be a failure below 35,666 or 665, not 666. That's the devil's number, right? Call it 665. But then really, I think it's 30. It's far away, but the moves have been really big. But I think your real level now here is going to be closer to 35,000. If that starts to give way, then I think it's the end of that party for now. But for as long as it holds, we can get some move back down. People thinking it's over, get down to low 35s and then start to move up again. Don't forget that we're in the last month of the year. There can be some window dressing. There can be some seasonals at play as well, which could drag it higher. But it's also going to depend on what's happening to the yields. I think if if we get like, okay, and that was an overshoot because it held around 424, 23 on the 10s, and we end the week just above, you know, it's going to be to me it's going to be enough to end above 433, 36, just to name the 10s, because I said on all of them we were on important levels here, even the short end as well. If we get the week, if we close the week back above 435, 36, I think then in turn the dollar may close the week on a better note, and perhaps the equity markets correct a little bit. So that about that. What am I going to look at? I'm going to look at a few euro crosses today, and just that to close our show. We are on relatively important levels. If you look at, for instance, on the daily on the euro yen, yeah, we have the baseline here. Those who are watching clouds, the clouds is much lower, okay? But those who are watching clouds, we are trading on the baseline here, 161. We also have a bit of support coming in here. We also have the 50% of that last move. We also have the 50% of that last move, you know, the October, the November rally, because risk was rallying, euro dollar was rallying, and dollar yen was coming down, perhaps, no, not perhaps, was coming down slower than the rest of the dollars were weakening. And the 50% also comes in at 161, the figure. So starting December, this could be a good point of measurement, okay? If you start to break down below 160, 70-ish, it could be that that this is weakening further. I'm a bit bearish, I can say, on the euro. I didn't like those European data. I also did not really understand why the euro would have been bought that much into month end. So we had the dollar move on the euro, but if you look at the euro moves here into month end, and then we had the acceleration over CPI as well. This is one that I'm going to keep a very close eye on, with the Canadian labor report out this afternoon as well. We're turning around this 147.5. Yesterday I said perhaps we can have a visit of the 147.5 going into the close of the month, which we did, but then we are needing a bit of an extension here right now. I still view this 147.5 as a bit of a level. I know the 200 moving average on the 4 hours is there, but I'm not a huge fan. But anyway, I think the 147.5 close above or below. If you don't want to have dollars on a Canadian labor report because Powell is on its way, look at something like the Euro Canada, because the euro is looking a bit fragile through the whole crosser spectrum this morning. If we start to move back above 147.80, there may be a bit of a run up to the 148s, but then we are going to what I think, unless the Canadian labor report is really crappy, we may be running into trouble here, just around this 148.35.50 zone on the Euro Canada. If in turn the Canadian report is better than expected, then I think that there is a possibility that we get back into this zone where we have been mooching around. Every time we came into that 146.5 zone, there's been a lot of activity. Stretch it down to 146, the figure perhaps. This is a possibility, I think, if the Canadian labor report is better than expected. Okay, and we're seeing all the euro crosses are under pressure. So as I said multiple times in the rooms as well, I think the euro the euro crosses could be under pressure for the end of the month. They were, and we are trying to extend those moves, but we are running into important levels shown on the euro yen, shown on the euro cat, and the euro Aussie is no exception. 164.5. That's your point of measurement to close the week. Okay, if the euro needs to regain some strength, it will have to start holding these levels. Okay, I am still thinking that there is a possibility, seeing those data, seeing the euro dollar also having found resistance finally, that there is a bit of a possibility that we are seeing some more weakness on the euro crosses. We covered the euro sterling already. We are there as well at relatively important levels because we are around the bottom of the daily cloud, and as Gav says, euro kiwi 175. Yet all those euro crosses are on important levels. We also see euro against emerging markets having found the top. There was a bit of a runaway into the opening of the day yesterday. It started to turn around on the euro mix. Now we are here on a level. Okay, this is to me also a bit of decision time to end the week and open next week, where December really starts, right? So this is another one that I'm keeping a close eye on. If we get a retest and another rejection, perhaps we can start moving lower again. So this about the euro crosses and a bit on the Canada. I could go on, but we're running out of time and it's Friday. Just have a relaxing weekend, everybody, after whatever may still happen on the rest of the day. Back over to you, Ryan.
Thank you very much, mate. And yeah, you can always come and check us out in the chat room. For those who aren't already in there, you know where we are. You can get to read and take part in all these sort of conversations that we have all day long. And I've got to say, yesterday was some of the best trading I've seen since I've been at ForexAnalytix in our chat room, from all the folks in there. Real professional stuff, you know, hitting their levels, trading their plans, picking the end of month stuff, OPEC, you name it. It was amazing in there yesterday. So come and check us out if you want. You know where to find us. And on that note, we will call it a week for the Flow Show. As ever, thank you for your support in what we do here and come in to the show. Don't forget to give us a like and a retweet and all that sort of palaver. Spread the word. We want plenty of you coming in here. We hope we've done you proud this week and continue to do you proud with the show. Thank you for taking part. Thank you to K-Man and all his input, for everyone around the back for what they do and keeping the show on the road. Have a great weekend, everybody, and we'll see you on Monday.
Thanks, Ryan. Have a great weekend, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.